Well, hello everyone, and welcome to our webinar here this afternoon where we're going to talk about technical analysis and we're going to try to make it easy. Joel, I'm going to pass this over to you now.
Okay, technical analysis made easy. Every morning on the show and on the site, we present numbers, technical levels, and we've gotten questions over the course of time, and how we come up with these. So today's presentation, going to do a quick rundown. We're going to talk about the multiple indicators that people follow, which sometimes equals multiple confusion. Using the KISS method of technical analysis. Keep it simple, stupid. The basic tenets: support, resistance based on highs, lows, and closes. And focus on the key levels for better trading setups for all. First, let's talk about some of the indicators that people use. Common technical indicators: Bollinger Bands. And just for me, Bollinger Bands are kind of always hitting a moving target. As you can see, the blue line highlighted there shows a 467.91 there, and that is the top of the band. Well, obviously Apple's far away from there, but when it gets back up to that level, that band is going to be expanding upwards. So to me, the Bollinger Bands are always hitting a moving target. Dennis, do you feel the same way about the Bollinger
It's tough.
Bands?
I don't, on my typical charts, I don't have any Bollinger Bands. I don't have a lot of this other stuff that we're going to talk about here in just a few minutes. What we're kind of going to do is show you a lot of indicators that a lot of traders use. It might work for some traders. I've been trading professionally for 14 years. This stuff has never worked for me. So we're kind of going to show you what we don't use at first and what a lot of other traders do, and then we're going to break it down into what we actually do use. So Bollinger Bands have been of no use to me for 14 years. If you have luck with them, not saying if you find that they work for you, they work for you. But if you're just trying to figure out how to use technical analysis, how to basically make money using charts, we're going to show you a lot simpler method. Here's another one too, Joel.
The commodity channel index. Dennis and I were joking about this a little bit. This was a indicator created in 1980, basically for commodities. Same kind of thing here. I mean, you do get the extreme levels where you're hit, over 100, and then supposedly that's supposed to be a sell area. Well, the thing about the commodity channel index is that another thing, it's kind of going to be a lagging indicator for you. I mean, if you're using the price points as stop outs and support and resistance levels, you're identifying exact levels. You're not waiting for lines to cross, perhaps sometimes after the moves occurred. Another thing, I know we got some fans out there: moving average, convergence, divergence. I mean, here, you could just sit and, look at the lines there, crossing through each other. Just giving you a lot of confusion there, and really no clear signals. You have support being showed up on the chart, and the lines are just all sticking together. So moving average, convergence, divergence is really something that I've studied, but not really understand or be able to.
And the one problem here too is it does lag when you look at when these are crossing. Obviously, when the 50 is crossing the 200, or you want to talk about different things like that. It's always lagging because the stock is already moving down when these happen, when these moves happen to occur. So you're always kind of a little bit late to the party when you're analyzing the stocks in this manner. And then moving averages are the same thing, obviously. You can say, oh, well, when they cross, you sell. When they cross back, you buy. But you can really get chopped around. In a real trending market, these can work okay. But when you get one of these markets that's basically just up and down a lot, you can get chopped up if you're trading, off of these moving averages in that way.
Right. Did people talk, about the 200-day moving average? I think majority of the people that listen to our show and our site are a little bit longer term, and they're not going to be making a lot of trades off the the 200-day moving average or the 50-day moving average. Maybe some shorter term things work, but even with your shorter term moving averages, you're even going to get more more choppiness than you have you have on the longer ones, the 50 or the 200-day moving average.
One we do like to use, Joel, and I'll let you talk about this one because you actually did make this call back a few weeks ago when Facebook had its 50% retracement. And what we're talking about is this whole move from the lows around that $18 area all the way back up into 32 and back at 25. This fib number here actually is one that we do like to use. It's a simple one, but the 50% retracement I think is valid. Is a valid tool to use.
Right, Facebook I think traded down to 17.55 and then made a move over the $32 level. Once it started to go into retreat, I did talk about coming down to the $25 level. That did mark the 50% retracement. It did get through there just on one trading session, and I was looking to hopefully it would get down there a couple times and consolidate, but this is one time where, boy, it just hit the 50% retracement right on the button and then took off. And also using this, if Facebook does come back down to that level, the $25 level, and you get sustained closes below that level, then perhaps you're looking for the thing to go back down, to the all-time low, I believe, which is 17.55. The other fib numbers, 0.382, I believe, and 0.618. Don't really pay attention to those. It's just I've had more success using the 50% retracements. I also use the 50% retracements on longer term moves to validate it. And then also if you're trading intraday, it's really, if you get a big move in the stock, it could be a decent level, especially if you're going against the trend. You're shorting a stock that's been rallying all day, which sometimes we tend to do. A lot of times you'll get a pullback and it will be to the 50% retracement. Also, if the 50% retracement on a daily chart, coincides with some other levels, some other prior lows or prior highs, that will definitely add significance to the number.
Now here's a little bit of a nightmare chart. It looks like some, a thing you'd see in the front of a rocket ship or something, the control panel here when you look at all this stuff on the chart. But here's throwing up all these indicators, and I've watched traders over my years, and just to give like my background there, I've been a professional trader with Bright Trading since 1999. And I traded out of the Detroit office for a better part of 13 years there. And I've seen a lot of traders come and go, and believe it or not, a lot of traders like to have this much stuff, and they're making decisions based on all of this technical derived information, and it just seems too complicated. Like, it's all about making it simpler, and this is just so complex here. What's your take, Joel?
Yeah, I mean, it's kind of analysis paralysis when you get things like this. What I've found, with working with traders and trading myself, if I have designated levels and you wait for those levels to come up in the market, then you have a plan. When it gets to that level, you can execute the plan. You can set yourself up with a stop level or a target, for an exit and whatnot. And it's just, if you make a bad trade, at least it's something that, you planned on, that you had, in the back of your mind, and you acted on a plan. And a plan, a change plan is better than no plan at all.
So basically, bottom line is, all of these indicators and stuff can actually lead to what you called analysis paralysis, confusion. It's making a simple thing more complicated. When I first started trading, I started trading professionally in 1999, and I think my first 6 months to a year was all kind of figuring out what not to do. And at the end of the day, then I started to figure out what to do, and it was all about making things simple. I'd analyze just simple supply and demand more than anything, as opposed to analyzing all these different technical indicators, making it all complicated. So what we try to do here, and what we do every day on premarketinfo.com, is we try to focus on key support and key resistance levels. And this helps us to make more informed trading decisions. And that's what we're going to talk to you about right now. So basically, okay, go ahead, Joel.
Well, bringing up a chart here of J&J, and just we probably have a lot of experienced people on here, and also some people that are new to the markets. But technical analysis is all about just support and resistance. Support, as you can see defined here, is a level where a stock comes to. This is a stock like J&J, may reach a level like 2 or 3 times. If an institution or a large trader is trying to accumulate a position, they will target an area, and then perhaps other traders figure out they're targeting an area. They'll up their bids ahead of the support level, especially if there's like a big institution resting at a whole numbers like to do. So that defines your support. Same way as resistance. You went up against the 6250 level on multiple occasions, pulled back quite significantly, and then finally, when you came up to it, after several attempts, you broke through the 6250 area, and you were in a breakout mode.
So basically, you can use support in a couple of main ways. It can identify you an area where you could enter a lower risk long position, or it can also be a target for a short position. You can also play the breakouts and the breakdowns, which we'll get to in a minute too. And the opposite's true with resistance. That can be an area where you might want to try to enter with a short position, or it might be a target for a long position. But these areas don't hold forever, and when they do break out of these areas, sometimes you can get opportunities that way too. And we're going to show you a few charts here just where that exactly did happen. This is a chart of Microsoft basically over the course of the last 6 months. This 28.36 level was absolutely enormous from basically January through March, 2 months, every time it got up just above 28. I know on the show in the morning we were joking that maybe as Bill Gates was sitting there and he just kept dumping stock because for whatever reason it would get up into the low 28s and would sell off, and it would get up in the low 28s and it would sell off. And there's all these little bars in here. A lot of these represent 40, 50, 60 cents. So if you were trading this and you identified this level early, there was a lot of opportunity where you could have made, multiple times you could have made 30, 40, 50 cents just selling off that major resistance level.
Right, and then you could see right before it broke out, I believe it hit it like 4 or 5 days in a row.
Yep.
And then I'm not sure if it was news related or whatnot, but this is something that you have to look at the charts every day. You have to follow perhaps a small group of stocks to be able to identify these levels. But once you do, it can really can set you up for a trading strategy over a course of a few days or a few weeks.
Here's another one that everybody likes to trade is Netflix, and this 176 support, and these charts are from a few days ago, so if they're not updated right here on the price, but you can see where this 176 support area held for so long, and then eventually, after you try it 1, 2, 3, 4, 5, 6, 7, 8 times or so, eventually it cracks and breaks, and when it broke hard, obviously falling about 15 points on the day that it did break that major support area. So these support areas are great to trade off of, and then when you see them breaking through and you see this thing eventually getting through and cutting through 174, 173, that's your opportunity to maybe try and initiate a short because it's obviously through the support now, and it may go down to the next major support area, which was down here in this whole 162 area.
Right. It just when you're trying to short stocks in the strength, I mean, especially the way these markets have been moving and a lot of times lack of liquidity. When you're shorting things when they're going up, I mean, they can just keep going up. They could just keep running. And sometimes it takes patience. You really want to short Netflix, and you want to identify an area. Maybe you have to wait, a week, 2 weeks, 3 weeks, a month, or whatever. But the time, when it gets that, you have to be prepared. Probably in a stock like on Netflix, you would probably have to use a sell stop, because the way these things move. But sometimes it's just identifying a level and just having the patience for the market to tell you what to do.
Yeah, it's a lot easier to short a stock when it's going down as opposed to short a stock that's going up. I mean, you could have said here before, oh, well, $100 is big on Netflix, and it was at the time, but then they had the good earnings report, and that's one thing about technical analysis. When you have an earnings report, you have something coming out on there, and you have a technical trade on, fundamentals are always take precedence over technicals. Company comes out and they're going bankrupt. I don't care what the chart looks like. Stocks going to zero. So when you have an earnings report coming up, it's very hard to take something home technically because they just might come out and blow the numbers away like they did in Netflix, and you could be caught with a gap and go. And that's exactly what happened here. The stock gapped and it just kept flying, flying, flying. Obviously got all the way up to almost $200 a share. So once it's gone, it's gone. Let it, you could have been trying to short it here and say, oh, well, the fundamentals don't make sense, I'm going to sell it. It's still moving up. You're fighting the tape. Well, here, finally, you get some consolidation, and then you have the breakdown. So now you actually have, it's all market timing. Trading is all market timing. And you can be right about Netflix, and maybe Netflix is going to be a $100 stock again. But remember, the market can remain irrational much longer than you can remain solvent. So these trades here, you need to be obviously cautious and trying not to short strong stocks, but short them when they start to get weaker. And that's the case with Netflix.
Yeah, one other thing about the Netflix charts here. I mean, the day before it had the breakdown, it did hit the 176 level, and I believe it closed just above it.
Yeah.
So you would have had it, when it's right there. I mean, sometimes, and we talk a lot about, the pre-market trading or the opening prints and whatnot. I mean, that would have been something where, you had to have the plan in place and most likely had a sell stop there in order to catch it.
Yeah. The whole key is make sure, and then we're in a decimal trading world, it's a $176 stock. Because it goes to 175.50 doesn't mean support is breached. That's still all in the relative same area. We're talking more a swing trading strategy here. You want to be sure, and that's why I would say I'd be more, inclined to short at 173 as opposed to 175.50, because I'm sure a couple of these little points here were slightly below 176. So it's not perfect. You have to have a little bit of risk. There's chop, we're in a high frequency trading world that has chop all over the place, so you need to give the trade a little bit. But when it's broken support, it's broken support. And here's your classic example from 4 days ago when Apple, and we talked about this 419 forever. It made the low initially at 419, tried it 2 or 3 times, could not breach it, rallied back up, came back down, found support, bounced off support one more time, came back down, took 2 days here hanging around the 419 area, and then the floodgates open, broke the 419. Within an hour and a half, the stock was at 400. So basically, if you were saying when this goes to 417, I'm going to short this thing, you would have taken no heat on the trade and you could have made it all the way down, and now obviously it's trading below 400. So, but even that one day, there was basically 4 to 5% worth of money here to make.
Right, and on that occasion, a lot of times on this one, when it blew through that 419, if you were sitting back hoping to catch a bounce back up to 419, you were SOL, because it just, the floodgates really opened there. And, there was a setup that took, starting in March, it took, over a month and a half for that to come to fruition. And, a lot of times it will give you a little bit of indication the day before that it broke down through that level. I believe it had one of its lowest closes, since it made that 419 low. But once again, these are things that happen very quickly, a lot of times off the open. If you pay attention to the pre-market highs and lows, I can't remember what it was in that day, but you can use that pre-market low as a parameter too. But that, those are quick moves, and if you were waiting to come back up to 419, you didn't get it. Now, when and if Apple ever goes back into the rally mode, I think there'll be quite a few offers there at 419, 420, as people that bought there are looking to exit their position.
Yeah, old support can become new resistance, and that's exactly it. You have a lot of people that are picking bottoms here, and now their break even is around that 419 area. So when it comes back up there, it's just psychological. Traders, investors more than anything, don't like to lose money on their trades. So when it comes back there and they can get even, they say, okay, I was way down the trade, now I've got my money back, I'm going to get out. So that is why, this, whole technical analysis on the resistance support becomes resistance. It comes into play just because of the psychology of the investor. Isn't
it great? You let it go $25 against you, and you get
and you make nothing.
Even. You're like, yeah, man, I'm getting out. Here's another classic stock. I know if our traders are active in higher price stocks, good luck to you. You do have lower price stocks here, like Pfizer, that will you'll see institutional orders in. I believe over the last 5 or 6 trading sessions, you made the highs between 30.94 and 30.99. Institution having a big order resting at 31, so the high frequency traders laying out those offers ahead of it, knowing pretty well if they're quick that they can cover at the $31 level. What's interesting about this chart is as many times as they hit 31, it's come back down to 30.45, 30.50. I believe that did that almost 5 days in a row. I don't think it got quite there today, but here is an example where you've had a defined range in a stock for the last 3 or 4 days, and you're not it's not a super high flyer. It doesn't move a whole lot, but here's a stock that you can trade a little bit more size in and be more comfortable with the levels.
Yeah, and that's exactly it. Like we say, a lot of times these support resistance areas are not even based, just on the chart. It's based on pure order flow. And there is institutions, typically some of them are lazier, and they just throw out, say, sell me 100,000 shares at the point, which is $31. Sell me another 100,000 shares at 32. Sell me another 100,000 at 33. And they layer, maybe they got 1 million shares, they're going to layer out all the way up like that. There's institutions that do that. So when you run into these whole numbers, you often run into this institutional resistance, is what I call it. High frequency guys feast on institutional orders because they know they can lean on that. They know they're fast. So if they sell at 30.97 and there's big offer at 31, they know they can get covered because they're that quick. So if the 31 starts to get traded out, they'll grab the back end of the order, only lose their 3 cents. So what it does is it really gives them a free look to the downside. And that's what they're doing here again and again, is basically piling in ahead of that $31 offer, selling at 30.95, 30.97, 30.94, and letting the trade come down a little bit. And you have shorter term traders that are doing that as well. So human traders doing that too. So a lot of people leaning on this whole $31 area, and that's what's happening. Eventually, if it hangs out here long enough, it probably takes it out. And then this resistance obviously is no longer the case because it was based purely on that institutional order that was sitting out there. So I'm not sure where Pfizer is right now. You could probably look it up. I know it was close to there, Joel, that 31. I don't think it's taken it out yet today either, though. No, it's at 30.91 right now. So it's hanging out right below that institutional order of 31. Continues to trade there. Eventually, though, 4, 5, 6, 7 times, eventually probably gets taken out. And then you'd be in breakout mode with Pfizer.
Right. And also, a lot of times we talk about this is when you get a higher close up in the upper quadrant. Let's say you get a 30.91 close or 30.92 close today. Monday, the market opened up strong. Then it only has, 8 cents to travel in order to take out that level, as opposed to days when it starts out at 30.55, or I believe 30.60 was the low today. If you look at the, the average daily range in Pfizer, it's 30.40 cents. It will take more, it takes the volume to get through there. If it happens early in the day, especially on the open when the high frequency traders aren't as apt to, participate, then you have a higher chance. And also, just one other thing on that, Dennis, is, a lot of times these institutions will have those orders for a couple days and then they'll pull them. So,
yeah,
and then, that's when you get, yeah.
Oh, yeah, if they pull them, then everybody scrambles for cover. But typically these ones that are at the whole numbers are their GTC. They're their good till canceled. Institution that holds it probably isn't even really watching the stock. They've just layered it out there. So these orders typically, if it's there 1, 2, 3 days, it's probably going to be there the 4th, 5th day. It's probably GTC, and it's probably not going to get canceled. So it probably has to trade out in order to trade higher. So that's your bogey. This 31 level is your bogey on Pfizer. Takes it out, then it can obviously travel higher. Until it does that, though, that remains critical resistance.
Yeah, and Mr. Bates is just asking about, the numbers that end in 00 like that, like 400 in Apple or in the SPOOs. It's a lot of it is just because of the institutions, and it's also just, psychological.
Yep.
I mean, only us day traders and our short-term traders, care about the pennies and the nickels. The little old lady from Pasadena, Apple's going down. Well, if it trades below 400, get me out. And that's just where the psychology comes in on on the whole number.
And that's another funny thing too. You raise a good point there, because you get little old lady from Pasadena saying on Apple trades below 400. And this might not be the best example because Apple's still down there. But what you'll sometimes get is these fake outs or fake downs, what I call them. If you have a key support level, we'll use Apple as an example, even though Apple is still trading below 400. But what sometimes will happen is when you get a key number like that, you'll actually see it trade through there just slightly, like 398, trigger a bunch of stops. The high freaks actually know there's going to probably be a lot of stops to trigger there. They'll actually try to take it through that key level, buy from those stops, and then the stock rallies up. So I mean, it's, sometimes they like to trade through those numbers just by a little smidgen, just to hit all those stops, and then obviously travels the other way. So a lot of times what you'll see is, even in this Pfizer case, sometimes you'll see it break out. It'll go to 3105, 3107, and then start to die off, and then it cuts back through 31 and then starts to really fall. So sometimes there is fake outs and fake downs is what I call them. So you need to be cautious of that as well. But this is just a classic example of institutional resistance. A lot of talk here. We were talking about how sometimes old resistance can become new support, and old support can become new resistance. A lot of wording here. I'm not going to make you guys read all that, but basically, when some stocks are breaking out, let's say that Pfizer does break over $31 from the example before, goes up to $31.50, comes back down to the 31 area. That area now becomes support, and sometimes it can bounce off that area the second time. So that's when we're saying old resistance can sometimes become new support.
Yeah, just going back to the Microsoft, we had showed that 2835 level had been resistance for a long time. You did get a blowout move in that a couple days ago, and it went back up to you went as high as 3032, and then negative IDC report. But just to finish up the whole thing, when it did pull back, I made several lows at the end of last week and this week in the 2850 area. I know it dipped under that, after the earnings release. But here's an example of all the institutions or all the traders that sold in the 2835 area here, looking for a scratch when it came back down there. It didn't come into that level, and then they had their up to bids. And I believe you had 2 or 3 lows at 2850, going back to the whole number theory.
I went and hunted down that chart for you, Joel, while you were talking there.
Okay.
So yeah, you can actually see, like, this old level we were talking about. You can see a little more clear here, this 2830, 2840 level over the course of the last few months. This is actually, I think, a chart of the last 60 days. So you can see here how this was major resistance. It comes all the way up, breaks out, and then comes down and retests it, hangs out. Then it had the big breakout day, which you were saying, and then the IDC report. Came back down in this whole 2850 area where it topped out a couple of times before. This area now served as support, and now it breaks out again. So, and here's an interesting part of the chart too. We're just kind of going away from our presentation for a second. But we've talked about this whole $29 area here, how it blew through there the first time. It blew through coming back down on the IDC report. Here it has earnings and actually blew through it again this morning. So when there's not a lot of trades in a certain area, it means that it can trade through that area with more relative ease. When it trades through that area in 2 days, it means it can come back down through it very quickly, and it can go back up through there quickly, because there's not a lot of traders who have positions on from this area. So there's not a lot of reference points in here, meaning there's just not a lot of support and resistance in here. So, and look at where it traveled to today. Is this not crazy? Was that high? 30.32,
30, yeah.
And it got to 30.24 today, so within 8 cents of that high, and then it reversed course again. So you can see how old highs that were resistance before becomes resistance here again, and here it is. It's 45 cents down from where it just was.
Right, and then we just got a question thrown in here about institutions and using volume of their price to determine support and resistance. I really only pay attention to volume when there's just blowout days in a stock and there's a huge move or whatever. You really for example in IBM today, the parameters are going to be established in IBM. High volume day, I will pay attention to those levels, but I don't key on volume traded at any particular price. What I do is I pay attention to the price and the repetitive of the times that it hits that level.
And you can see here, actually, look at the chart on the IBM here. Obviously, we had the crazy up move. when it had the earnings before, when it gapped up and it came back, and then it ran up here again. It broke down there a few days ago. Well, actually, it broke down today with bad earnings here, and traveled up quickly through this area, gaps down through the area on the way back, and boom, it's chopped all the way down. That's an extreme move to get down here all the way to 190. You could have said, oh, well, maybe there was some, if you would have been playing the old resistance becomes support here, it wouldn't have worked. So you need to be able to recognize quickly when it's not working, and obviously get out of the trade too, because these are all just, different ideas. These are all just tools for you more than anything, but you need to be able to recognize when that, old support's not going to be support.
And just my experience over the years that being on trading desks and running offices and stuff, I mean, even traders that love to short the market, you get a move like that in IBM, and they are just trying to pick bottoms in there. So, I mean, it's good that it's good to be a contrarian and do those kind of things, but you have to recognize, really quickly if you're doing something like that, don't add to losing positions, don't keep doing the same thing.
Here's an example, Joel, and we talk about this a lot of times here. J.C. Penney actually made this double top, triple top area, but if you look at these two spots right here, high one day was 1794, next day was 1795. This is a classic double top right here. Stock broke down, died, came back up, and then sold off again. But what you won't see on this chart, because this is an intraday chart, you won't see the pre-market and the after-hours action. And when Johnson was fired there, what was it, about 3-4 weeks ago? Was it that long ago? I can't always remember the time.
A couple weeks ago, yeah.
Yeah, a couple weeks ago when they fired Johnson. Believe it or not, after hours, this stock traded up to 1789. Right at that double top, quickly reversed course, and then they were announced that they were bringing the old CEO back, and obviously the stock, we know the story after then, gave back all of its gains after hours, started trading down, and the next day really started trading down, getting all the way down in the whole $14 area. But you could have literally made about $2 here in about 10 minutes after hours just by identifying and knowing, well, this is running. It's up 10% now on this Johnson firing here. I think it's overdone now. I just want to figure out where am I going to short it. Well, I've got this beautiful double top that this thing's coming into, and in this case it would have worked out nicely. You could have got short right around 1780, 1789, and made a quick couple of points.
Right, and also, I mean, you could stick your neck out and short it, but if you had, had a long position and you got that kind of spike, obviously the safer thing to do, would be to exit the trade, because you certainly didn't get that opportunity to do it after the pre-market trading.
So here's what we do for you on our Premarket Info site every day, and I'm going to let Joel explain this because he's the master behind the numbers. We give these support and resistance levels for all of your top S&P components, the top 10 components, which actually make up 20% of the index. Joel does this for you every day, and we're going to show you on the site here in a second, but he's just going to quickly explain what you're looking at with these numbers. Joel, I'll let you take over on this.
All right, could you pull up the site there
Sure.
for something that's a little bit more relevant
Sure.
here?
Can you see them there?
Okay. Yep, we can. Just taking the S&Ps for example. What I like to do is the first number that I always start with, obviously, is the close, 1534, and that's where I start that out in my matrix. I also like to use pivot points and the pivot point formula. If you guys Google that, you can come up with the components of that. But I really like to use those numbers if they coincide with other numbers that I have. I think that the pivot and the R1 and the R2, they are decent numbers. They do give you reference points when things are running. But what I like to do is I like to use the pivot as a primary number along with the close. We had the week close yesterday at 1534. Opened up above that level. The good earnings outweighed the bad earnings. So if you were trying to buy the close yesterday, that level was never exceeded. So people had to up their bids in order to do that. 1539.50 was the daily pivot for a day. So if I had been playing it in a long early in the session, would have used that as a swing point, just gave that a 3-star significant. And then when you start getting in 1-star levels here, that means it was a reference point from some time, either from the formula or Wednesday's close, for example. Going up a little bit higher, I like to keep track of the intraday highs and the Globex highs. As you all know, the S&Ps trade until 5:15. That ends the daily session. So I consider that the intraday session. As it turns out, today the S&Ps, I'm not sure what the current high is, but Thursday's intraday high was 1549.50. And a lot of people don't mess with the pre-market or the after-hours sessions, that either don't have access to it or don't put credence in the activity. But when you see the intraday high like that, that just means between the 9:30 and the 4 o'clock session. And then above that, you have Thursday, obviously the Globex high. Coming back on the downside here after the 1534. I mean, I put 1530.75. I mean, I put that as a 2-star. It was Thursday's low. There was significance, but with the way the momentum was going down in the market, it did not add as much significance to me as the 2950 low from March 18th. And then, going below that, sometimes I have to go back days, weeks, months, sometimes even years in the case of Apple to find levels. But if you go back and look at your charts, I mean, you will find, relevant levels that correspond. 1519.75 was the low on March 5th. And then if we ever do break below 1519.17, I really don't see a whole lot until going down to 1502.25, which was the low on the 4th. A lot of times though, what you'll see is it will take a couple days, a couple weeks, a couple months, unless there's some kind of worldwide event. But same with the S&Ps. Same. Could you scroll down to Pfizer, a stock like Pfizer here? It's all the way at the bottom, or I think second from the bottom.
Yep. See you there, Joel?
You see the 5 or 6 lows there. I start piling on the stars. When you see stars like that, I mean, if you're short coming in that area, I don't care if it's been there 5 out of 6 times. It's a significant level. Obviously, 45 was the lowest of those lows. It hit 48 yesterday. People start up in the bids, and then you can see here Monday and Tuesday's high. We're just ahead of the big seller at 31. Wednesdays and Thursdays highs here. So basically what you see in the numbers are all daily highs and lows. Another thing that I like to look for is multiple closes in the area, because there are traders on desks, institutional traders or proprietary traders that get marked on their P&L to the close. And if something is going against them and they can get out at the mark, a lot of times the close could be a significant level as well.
Let me just show you the Pfizer chart here, which what Joel has been putting for these numbers. And if you were on the numbers for the last 3 or 4 days, these numbers have basically been there. Like, you start adding stars as these numbers become more and more relevant. What stands out to you here? What stands out to me in this chart, in this numbers here, is 30.99 and 30.48. And when you got 1 stars, it means there's just not much in there. It means the stock can move through that area with relative ease. And that's what I'm looking for when I'm using your numbers, Joel. I'm looking for areas that it's probably going to move through with relative ease. And if you look here at the chart from the last 7 days, what we have here is the stock moving with relative ease through that area, up and down, up and down. And between those numbers that you had cited, this is obviously a very perfect, they don't always work this nice, but this one has worked very nicely here. I mean, if you were just selling it up here at these 4-star level and buying it down here at this like bazillion star level that you got there, obviously you did very well, because there's one, you could have bought here 1, 2, 3, 4, 5, 6 times here, made money each time. Could have shorted up here 1, 2, 3, 4, 5 times or so too. This is just a hell of a level to basically, remember that old site channelingstocks.com? Yeah, well, this is the channel. Joel's defined the channel for you here, and now obviously you can see here the stock just continues to move in that channel. So eventually this trade is going to break out one way or another. I tend to think with the strength in the drug stocks, it's going to be the upside. And then you can can look, and once you get above 31, well, Joel will have to add some more numbers after, but there's not much
I
in there
actually know
either.
where it's at because when we were pressing up against 31, I think it's like the October 2004 high of 3150. Is really the next,
I gotta go
next
back to
level. It might take a little while to
2004. I
get
can't even
there,
go
but
back that far on my chart. It only goes to 2005,
yeah.
this one, so.
But I just want to reiterate, these are rare examples. I mean, these are things that, by following, the same group of stocks, by doing the levels every day on the same group of stocks, you become in tune to them, and you can set up strategies with the high frequency trading now, the volatility things, outside events, affecting what goes on in the market. It's good to have a plan, and it's good to, see where these levels correspond. A lot of times these levels you'll see a big move in the pre-market. For example, that move in J.C. Penney. And I remember we were online, you're telling me, man, someone's dumping hundreds of thousands of shares here. And, well, there was the same person that was there a couple weeks ago, selling at that level. So I guess basically, we're getting a little bit long here in the seminar, but just want to point out examples that, how to use these numbers. I could do numbers on any stock because I use the same basic formula with the pivots, with the daily highs and lows and closes. I mean, the higher price stocks, little bit more difficult to do the numbers on. Like today, I got a 50-point range in the Gookster, and I mean, because that's what's based on the volatility. Also, I'm to point out another example in Gookster. During the pre-market session, it got to 796.75, and if you go back, I believe it was Tuesdays and Wednesdays highs were between 796 and 797. So, these levels, if you're diligent and you do them and you keep on them, well, you will have a plan, and that's the best way to approach trading.
I mean, that's what it's all about, is just having some type of a game plan here. And I think the main point I want to make on these is when you only got a 1-star there, I don't put much relevance. I almost kind of ignore it. So what I would see is like a gap here between 771 and 776. And Google's like a very, very difficult stock to trade. It trades with a 20-30 cent spread all the time. It's a $700 stock. I tend to pick on like the Procter and Gamble's, the Johnson and Johnson's. Those ones a little bit more. But Joel does these numbers. He updates these every single morning about 8 o'clock, 8:30 in the morning, usually at the latest. You just go to www.premarketinfo.com and then click the S&P levels tab. So if you go to premarketinfo.com, you'll come to our front page, which is working slowly, and then you go over and you click the S&P levels, and then you'll be there. So that's where you'll find that information, which is updated daily. And like I said, Joel updates it for the E-mini up top and the top 10 components, which make up 20% of the index, with Apple, ExxonMobil, and GE, and so forth. So obviously, these numbers are just another tool for you. They don't work in stone, but it's a tool for you to use, and it's free for you if you come to the site, and you can check them out.
Right. And before we end the webinar, I just want to thank Brent Slava. He's been here being my right-hand man with the questions and everything. And due to my lack of technical preparation, I couldn't get him on with the mic, but he's been chatting with you guys all, and I'd just like to thank him here for patiently listening to the seminar and listening to all my squawking during the day on Benzinga Pro. That's one other thing I'd like to add is that Pre-Market Info is affiliating itself with Benzinga Pro. I have been doing some squawking on their Thinkorswim platform, chat room, and also on their Benzinga Pro. Kind of just pounding these same numbers into your head as I do during the Pre-Market Info show. So if you get a chance, sign up for a free trial on that. And if we have any more questions out there in the crowd, we will answer those. If not, we will get back here to the last hour of trading. And I want to thank you all for participating.